Let's dig into pre-One Big Beautiful Bill Act and how it was impacted by charitable giving and post 2026 and beyond. Right now, 2025 and in years earlier, if you wanted to have charitable giving be a part of your tax plan, you had to be someone that itemized your taxes. Going back to the formula, you take your total income, you have certain above the line tax deductions that anyone can benefit from, such as pre-tax retirement contributions or health savings account contributions. After you've taken advantage of those above the line tax deductions, you have your adjusted gross income. And at that point, you have to make a decision of whether you're going to take the standard deduction available to all taxpayers or whether you're actually going to tally up your own itemized tax deductions because they exceed what's available in the standard deduction. Well, prior to 2026, the only way that charitable giving would help you from your tax return is if you chose to itemize. As a matter of fact, it's very similar to what we've talked about with owning a home, where someone will tell you to buy a home because it helps you on your taxes. And in reality, buying a home only helps on your taxes if you itemize. And while people do give to charities for the right reasons, I cannot tell you how many people will total up, hey, I gave $50 at this breakfast, $100 at this breakfast at the end of the year, thinking they'll get some benefit from it just to be told, hey, in your circumstance, it doesn't really matter because you've chosen to take the standard deduction. It's more than what you have available on the itemized side. So this isn't something from which you'll be able to benefit. Now that's changing radically as a result of the One Big Beautiful Bill. I just need to remind every time I say that, that's not my nickname for it. That's the actual name of the bill. But it did change charitable giving in some really unique ways. The first is if you choose to take the standard deduction, it creates an above the line tax deduction for charitable giving. If you're a single taxpayer, it's up to $1,000 of charitable contributions. If you're a married filing jointly taxpayer, it's up to $2,000. So you, for example, might make $100,000 of total income. If you gave $5,000 in charitable contributions and chose to take the standard deduction, you'd be able to deduct $2,000 worth of that $5,000 of contributions as an above the line tax deduction before you reach your adjusted gross income. Now that's a big benefit to people who couldn't participate before, but unfortunately there's been a barrier introduced to people who itemize their taxes. And this makes sense because the Trump administration has been trying since their first go round to make sure that the overwhelming majority of people are using the standard deduction. So they in some ways try to disincentivize you from itemizing, and this threshold is something that I think is an example of that. The threshold is 0.5% of your adjusted gross income, and it's similar in the way it works to how medical expenses work. So for medical expenses, if you itemize your tax return, you can only deduct the expenses that exceed 7.5% of your adjusted gross income. Let's say your adjusted gross income was $100,000. Well, you have to clear a $7,500 floor, 7.5% of that. So if you had $10,000 in medical expenses, you can really only deduct the $2,500 that's above that threshold. Well, with charitable giving, that 0.5% floor means that in the example of someone who has $100,000 adjusted gross income, they have to give at least $500 before anything above that amount can be deducted as an itemized deduction. So for our consistent $5,000 contribution example, in this instance, they will be able to deduct $4,500 because that's the amount that clears the 0.5% floor. Now, it's important that you understand that these have to be cash contributions. So as I said, we're going to do some future episodes where we talk about some of the things that you might have heard about unique ways to give that are beneficial, but the contributions that meet this threshold have to be ones that are given directly. It can't be through something like a donor advised fund. And this is why, if this is something that you're doing for tax purposes, it has to be integrated with an entire strategy, both so you understand just how much you have to give before it actually benefits you, and telling your tax preparer how much you plan to give so they can let you know in which strategy that might fit best. For example, let's say we had someone who wanted to give $1,000, but that's not that high above their 0.5% threshold. They may actually get more benefit from using the new above the line tax deduction that's available for people who file for the standard deduction. So having a plan in place and an understanding of how this fits into the other elements of your finances is crucial, because even something as seemingly small as giving $100 to an organization you're passionate about is something that has an impact on the rest of your finances. Nothing that you do when it comes to money happens in a vacuum. It all touches the other areas of your plan, and having the knowledge of how it touches those areas is crucial in making sure you use it to the benefit of your wealth.